So guys, these four sections, okay? Where is your notebook? ಹೋಯ್ತು ಸ್ವಲ್ಪ ಕೊಡಿ notebook. ಏನಾಯ್ತು? That you can write a little later, previous ones. Let him draw. Okay. Types of liquidity ratio, leverage ratio, turnover ratio, profitability ratio. Under each of them, we have a lot to study, okay? And you have to study. It's more like a by heart. I don't have anything else to do here. You just have to. There's nothing I need to teach here. It's just some formula by heart it. I'll ask you. Bas. Okay. Then guys, put a first one liquidity. Put a heading liquidity ratios. Liquidity ratios. Liquidity ratios. Okay. So guys, liquidity ratio basically short-term solvency ratio. So short-term solvency or liquidity means ability of the company to meet its short-term obligations. Is short-term liability or short-term liability. Short-term obligation means short-term liability or simply current liability. So guys, short liquidity ratio or short-term solvency ratio are those ratios help us understand whether the company has to pay its short-term obligations or not. So those are the ratios that we'll discuss here in liquidity ratio. Just write below. Let's write the statement. Liquidity ratios or short-term solvency ratios. Liquidity ratios or short-term solvency ratios. Liquidity ratio or short-term solvency ratios are those ratios are those ratios are those ratios which help us 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 to identify to identify to identify whether the company has the ability to whether the company has the ability to whether the company has the ability to meet its short-term obligations to meet its short-term obligations. Okay. So basically, do you have any? Can you meet the current liabilities or not? This is the question. Okay. In that first ratio, guys, it is current ratio. First one, current ratio. First one, every ratio, please put it in a bracket. Okay, current ratio. Current ratio is equal to what? Current assets divided by current liabilities. Current assets divided by current liabilities. 'Okay? Current assets divided by current liabilities. Okay, current assets divided by current liabilities. 'Okay, 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 current assets divided by current liabilities. Okay, current assets divided by. So guys, this particular ratio will tell me whether the company has enough current assets to meet its current liabilities. Whether it has enough current assets to meet it, to cover its current liability. Okay. Okay. Do you want to write the explanation for each ratio, or because there's nothing much in the exam also, you just need this only, you don't need anything else. I'll just explain you for each one. Now wherever required you tell me, we'll write, otherwise not required. Okay, here it is basically telling us whether you have enough current assets to meet its current liabilities or not. This is what this formula says. Okay. Okay, I want to write what is current asset. This you put in bracket. I want to write what is current asset and what is included in current asset and what is included in current liability. Okay, write below where current assets is equal. Current assets is equal to. Okay, can you tell me if you current assets? What are items available in current assets? Debtors, bills receivable, stock, cash and bank. Okay, these are the items. Let's write that down. I'm asking you to write because of some reason. Just write that down. Where current assets is equal to inventories. Inventories. Current assets is equal to inventories plus debtors plus debtors plus cash and bank plus cash and bank plus cash and bank plus receivables plus receivables plus receivables in write in bracket accruals, receivables or accruals, whatever we have to receive, receivables, or in bracket you write accruals, bracket close, plus loans and advances, plus loans and advances, plus loans and advances, plus disposable investments, plus disposable investments, plus etc, plus etc. So current assets, I'll repeat once again: inventories, debtors, cash and bank, receivables or accruals, loans and advances, disposable investment, plus etc. Okay, these are all examples of current. There may be more, but majorly these are the ones. Then you write current liabilities is equal to, current liabilities is equal to, current liabilities is equal to creditors. Current liabilities is equal to creditors, creditors plus short-term loans, plus short-term loans, plus short-term loans, plus short-term loans, plus bank overdraft, plus bank overdraft, plus bank overdraft, plus bank overdraft, plus cash credit, plus cash credit, plus cash credit, plus outstanding expenses, plus outstanding expenses, outstanding expenses, basically payables only, outstanding expenses, plus provision for tax, plus provision for tax, plus provision for tax, provision for tax, plus proposed dividend, plus proposed dividend, plus proposed dividend, plus unclaimed dividend, plus unclaimed dividend, plus unclaimed dividend, etc. Okay, now guys, in this chapter what happens is, there in some question you will see some ratios used in some manner. Okay, few might have added, few might have reduced. The inherent problem with this chapter, if I take the same ratio here, go to CMA textbook, go to CS textbook, go to ChatGPT, go to Grow, go to Gemini, go to Copilot. Everything might give you a different numbers. Some might say current ratio to current asset to current liability, some might say current ratio is equal to quick asset development. So there may be variations in formula. So don't be worried, because based on whatever question available, you solve it and you write that whatever assumptions that you have to make. Because this chapter has inherent problem. If you Google same thing, you will find something else. So don't be worried. It is in different places. I'm teaching you what is there in textbook, our textbook. Okay, that is safer for us. In the problem, sometimes you only will see some other way used, but we don't have any. I don't have any explanation for it. It is just used in different manner. Okay. So sometimes you see, you Google it, you find it some other, then don't blame me, I am wrong. Okay. So there are different interpretation to formulas. Okay. In textbook, this is how it is given. Okay. So current ratio is current assets divided by current liability. Now my question, guys. Current ratio is current assets divided by current liability. Is it good to have current ratio, higher current ratio or lower current ratio? Higher current ratio or lower current ratio? Or tell me a number wherever you feel sufficient for current ratio. How much? 1. More than 2 is to 1. Okay. So generally, guys, more than 1 is preferred, because you need at least so much. Otherwise, you will not be able to pay. A person comes, a payable, a creditor come, you don't have enough cash to pay. It's a problem. This will lead to bigger problems if it continues. So always it is preferable to have more than 1. And 2 to 1, I don't know, because I can't put a number to it. What happens is there are different kinds of industries. There may be some industries which is very cash crunch. So for, say for example, if you see if you have some agriculture, let's say some coconut or coconut or whatever, you say you go to a shop, you give them the stock whatever you have, they will immediately give you cash. They can't keep it further. But when they get cash late. When they have a big quantum, only then they will sell. So they might have to have cash immediately. So they might have to have a lot of current assets. So it depends on the business. Then there will be big company, for example, a big Tata Communication or whatever. So their vendors will, their customer will pay them immediate cash, but their vendors, they won't need much cash initially. So it depends on the industry which is bad. In general sense, more than 1 is, this is a general scenario. This is not applicable everywhere, but general scenario, more than 1 is preferable. And some places you will see current ratio 2 is to 1 is preferable. This is not standard. This is just an indicated number that is applicable to some companies. So this is not applicable to everyone. So every ratio, different industry will require minimum different numbers. Okay. So don't just think 2 is to 1 is better. Don't even think more than 1 is better. There may be some scenario where less than 1 is better. Okay. So it depends on the industry. But in the textbook, in some ratios, you will see. So in current ratio, say for example, they've written generally accepted current ratio is 2 is to 1. So they would have given some number, but that is not ideal for all. It is just an indicated number. Okay. And some other places also they have given ideal number as this, but I don't ask you to study it. They never ask it directly. How much is the current ratio best? They don't do that. They just give you the number. You have to do the problem. That's all. Okay. So this current ratio. Okay. We'll move on to the next one. Quick ratio. Next one is quick ratio. Quick ratio. Quick ratio is quick assets divided by current liability. Quick assets, quick ratio is equal to quick assets divided by current liabilities. Where quick assets means current assets minus inventories minus prepaid expenses. Quick ratio is equal to quick assets divided by current liability, and quick assets mean current assets minus inventories minus prepaid expenses. Quick ratio is equal to quick assets divided by current liability. Quick asset is equal to quick current assets minus inventories minus prepaid expense. Okay, this also we have very similar interpretation of current ratio. Only difference is now you are measuring the ability of the company to meet the current liability using quick asset. Quick asset means those assets that can be converted quickly to cash. Inventory is basically will take time to sell and get the realize the money. Prepaid expenses already, you know what prepaid expenses? You already paid, you are not getting any cash back. You paid it, okay, you'll adjust again in future, you are not getting it back. So this is essentially not a quick. So that's why they just remove. Okay, write this formula also. Okay, quick assets is equal to current assets minus inventories minus prepaid expense. Okay, so quick ratio so much, put it in a box. Okay, so generally quick assets considered, they have given the number 1:1, they have said. Okay, you should at least have that much quick assets to meet the current liability. Okay, here it included those two, here not included. They are saying cash, near cash item should be able to meet the current liability. Okay, that's what they say. The next one, cash ratio. Next one is cash ratio. Cash ratio. Cash ratio. Cash and bank balance. Cash and bank plus marketable securities divided by current liabilities. Guys, you wrote quick ratio, right? In bracket, you write there is one more word for quick ratio. It is also called acid test ratio. Quick ratio is also called test acid test ratio. Cash ratio is cash plus bank marketable securities divided by current liabilities. So guys, here it was entire here the quick asset very near to. So this is basically marketable security, which means you can sell it immediately if you want. You can sell it anytime. If you want money today, you just click a button, you get the cash. So those kind of securities. So cash. Here the money very to meet your current liabilities. Okay, this is what is cash ratio. Cash ratio. Okay. Okay, we'll move to the next one. Basic defense interval. The next one, I'll rub this. Okay. I'll rub this. This is our basic defense interval. Basic defense interval. Guys, you have studied these ratios somewhere in your BCom, no? Yes? You remember all this? No. That you know. Okay. Not everything, sir. Okay. Basic defense interval. basic defense level. You have two equations: cash and bank plus marketable securities, marketable securities plus, or basically debtors, net receivables. Can we write debtors? 1 minute. I write as receivable for now. Let me write receivables only. Daily operating expenses. Cash and bank plus marketable security plus receivables divided by daily operating expenses. Or there is another formula. Current assets minus inventories minus prepaid expenses divided by daily operating expenses. Current assets minus expenses, current assets minus inventories minus prepaid expenses divided by daily operating expenses. Now, what is daily operating expense? You do one thing, you write daily cash operating expense, okay? Daily cash operating expense, sorry, my bad. Daily cash operating expenses. Okay, daily cash. And how to compute daily operating cash expense? Daily cash operating expense. Daily cash operating expense. Can compute this by COGS plus, COGS, cost of goods sold, plus selling and administration expense. SNA, if you write, you will understand now, right? Let me. Sales, administrative, general, and other general expenses minus non-cash items divided by number of days in a year. Bill of exchange. Not really. This is basically stock, like share you buy. You buy discount. You discount it, but again it will take time. We need quick cash. Here you just need to click a button. Okay. And bill discounting, if you say recent technology allow me to discount with the click of button, then maybe you want, you can include it. I don't have any problem. But as a blanket, I tell you no. Just have shares. So which is immediately, it's very, you just click of a button, it should get converted into cash. That's what we call it marketable security. It's very near to cash. Again, it is up to some people might say yeah include, some people will say will not include. So it's again nothing wrong. There's no correct or wrong answer. It is just different interpretations of different formulas. Guys, what is this thing? This much, this much. Quick. People will say this is letters, sir. Guys, this the numerator is quick assets. If you see, current assets minus inventory minus prepaid expenses. This is quick assets. This is quick assets divided by daily cash operating expenses. Okay. What is quick asset? You have to know. Daily operating expenses. You have to know. So you take all cash, you reduce all the non-cash items. Then you divide by number of years. So now, what does this particular ratio tells us? Listen carefully, guys. Say for example, the company's sales stop. Okay, tomorrow a war came. War has come. Because of that, company had to stop. This particular ratio will tell us how many days can you survive without getting any money from outside. How many days can you survive or can you meet your current liabilities? How many days can you run? You will have daily operating expenses. If you operate, you will have some expenses. So basically, if all the sales, how many days can you run your business? How many days can you meet your operating expenses? That is what this ratio will tell us. So say this much is the money that you have, and one day you spend say 10 lakh rupees. So with that money, this will give you the number of days. How many days can you survive with the cash? Say for example, you have say 50 lakh rupees with you, cash, bank, marketable security, receive. Altogether you have 50 lakhs. And one day to run the business, you need 2 lakhs. One day you need 2 lakhs to run the business. So this will give you, you can run the business for 25 days. This is what this ratio says. If all the sales were to cease, how many days can you run the business with no external help? This is what basic defense interval will tell. And here, this is quick assets. Can be written this way or this way? And the daily cash operating expenses, all these expenses we take it, we reduce non-cash items if there is any. Non-cash, I mean depreciation, amortization, unrealized provision, all this. And then you divide by number of days. Normally 360 or 365 depending upon the scenario. We'll write the interpretation here. We'll write that interpretation here. Right below. If for some reason, all the company's revenue, all the company's QMPA NY apostrophe S, okay, not too many companies, one company is of that company. I mean, if for some reason all the companies COMPA NY apostrophe S companies revenues were to suddenly cease or suddenly stop, were to suddenly stop or cease, okay, suddenly stop, comma, the basic defense interval would help determine the basic defense interval would help determine the basic defense interval would help determine the number of days for which the number of days for which the company can cover its cash expenses without the aid of additional financing, without the aid of additional financing. without the aid of additional financing. Okay, so this is basic difference interval. You have the formula cash in bank plus marketable security plus receivable divided by daily cash operating expenses. Current assets minus inventory minus prepaid expense divided by daily cash operating expenses. Okay, daily cash operating costs plus sales administration and other expenses minus non-cash items divided by number of days in a year. Okay, the last equation, last ratio in this section, net working capital. Net working capital. What is net working capital? What? Current assets minus current liabilities. So guys, current ratio and net working capital same. One is division, one is minus. Not the same. Right, net working capital. Net working capital is equal to current assets minus current liabilities. Net working capital is equal to current assets minus current liabilities. Guys, in current liabilities, you write in bracket, in current liabilities, bracket, excluding short-term bank borrowings. Current assets minus current liability. In current liability bracket, you write excluding short-term bank borrowing. Excluding short-term bank borrowing. So normally when we say working capital, we simply say current assets minus current liability. Here in textbook, it is given it like this. That's why I gave you excluding short-term bank borrowing. So in the question, if they say specifically about short-term bank borrowing, just ignore it. Don't take it because current liability has to be taken without short-term bank loans. So net working capital is current assets minus current liability. This is basically the excess of current assets over current liability. So more than zero is preferable, but again, it's not again for standard. It is more of a common. Guys, quickly study these. Give you 5 minutes. Quickly study the formulas. Nothing much to study, but quickly study. It's done. Okay, close it now. Close ಮಾಡಿ ಸ್ವಲ್ಪ. So many ಐದು salas comes now. This ratio chapter so many ಐದು ಸಲ. Okay, ಸ್ವಲ್ಪ ಕ್ಲೋಸ್ ಮಾಡಿ. ಕ್ಲೋಸ್ ಮಾಡಿ. ಅನನ್ಯ ಪಾಂಡೆ ಮಾಡಿ. Middle don't keep anything. Okay. Take it outside. Take the pens outside, guys. ಪೆನ್ ಸ್ವಲ್ಪ ಔಟ್ಸೈಡ್ ಹಾಕಿ ಕ್ಲೋಸ್ ಮಾಡಿ ಸ್ವಲ್ಪ. ಚಿನ್ನು, we'll start with you. Current ratio. Current assets divided by current liability. Munu sir, current ratio. Net working capital. ಐದು ಸಲ. Not ಐದು ಸಲ ಜಾಸ್ತಿ, just everything. Okay, every formula. Net working capital. Current assets minus. Gone. We started doing this from investment chapter. Working capital, current asset. Quick ratio. What is quick assets? Cash and bank plus marketable security plus no. ಐದು ಸಲ. What is quick asset? Current assets. Current assets. What? Once again. What is quick assets? Okay. Or you can do another way. From basic difference interval, we had another equation. Quick assets. Same equation, is it? Same equation. We had one more, very similar. Divided by. Okay, we'll go to there a little later. Okay. Tamil. What is asset test ratio? Quick assets divided by current liability. What is quick assets? Current assets minus inventory minus prepaid expense. Basic difference interval. Cash and bank plus marketable securities plus receivables divided by daily gift or quick assets divided by how do you do quick assets? Current assets minus inventories minus prepaid expenses divided by daily cash operating. How to find out daily cash operating expense? ಐದು ಸಲ. Hari, daily cash operating expenses. COGS plus sales and administrative. Non-cash items. Non-cash item divided by current liabilities. No. ಐದು current liability ಐದು ಸಲ. Divided by what? Number of days in a year. Divided by current liability, it seems. I put it in your mouth, but still. Okay, ಸ್ವಲ್ಪ ಹೇಳಿ. What is what did we call? We had a quick ratio. We had one more ratio, right? Cash ratio. Cash ratio ಹೇಳಿ. Cash and bank. Plus securities. I will give you one more chance. Go ahead. Cash and bank. What security? Marketable security? Yes. Okay. Divided by current. Correct. It's correct. Nagesh, ಸ್ವಲ್ಪ basic difference interval ಹೇಳಿ. Difference interval. Cash and bank plus minus marketable security plus inventories divided by daily cash operating or Quick assets. How do you find out quick assets? Cash in bank minus inventories. I will give you one more chance. What is quick assets? Hmm. Current assets minus inventory minus prepaid assets. So quick assets, you have two formulas. One, current assets minus, tell me, current assets minus inventories minus prepaid expenses, or not that, wait, or cash in bank plus inventory. This is what I meant earlier. Okay, two formulas for quick assets. Either you can do current assets minus inventories minus, or what you can do is you can do cash and bank plus marketable security plus inventories. Sorry, not receivable. Sorry, my bad. Okay, plus receipt. Tamil go. I did not ask you, right? What did I ask? Quick ratio. Tell me cash ratio. Not you, him. Arvind, Hilly. Cash ratio. Ajusala. Current assets divided by? Don't talk. Cash ratio. ಐದು ಸಲ ಎಷ್ಟು ಒಂದು ಸ್ವಲ್ಪ ಹೇಳಿ. Cash in bank plus marketable security divided by, okay, ಅಷ್ಟು ಸಾಕು ಇವತ್ತು. Okay, let's move. Open the book. Okay, let's move now. Guys, 5 sala, 10 sala, please show me today. If not, again, this 10 sala will become 100 sala. Don't tell me. Tomorrow, sure. Please. Okay, guys, let's move on to the next category of equations. That is long-term solvency or leverage ratios. Leverage ratios or long-term solvency ratios. Okay, guys, let's look at long-term solvency or leverage ratio. So guys, long-term solvency or leverage ratios basically helps us identify whether the company has a good capital structure or stable capital structure. Okay? It helps us to identify whether the company is able to meet all its obligation on a long-term basis. There we talk about short-term solvency. Here we are talking about long-term solvency. Or we look at the company and see whether the capital mix is good or bad. This is what we'll be talking long-term solvency. Okay, let's write that. Long-term leverage ratios. These ratios measure the long-term stability, and capital structure of the firm. Long-term stability and capital structure of the firm. Okay, here we have two categories, guys. In leverage ratio, we have two categories. Okay, first one, capital structure ratios, and coverage ratios. Capital structure ratios and coverage ratio. Just draw this. Leverage ratios, two category, capital structure ratios and coverage ratio. Then we'll talk about capital structure ratios one by one. Okay. So here we'll look at the long-term solvency position, guys. In capital structure ratio, we'll look at the long-term solvency. Okay. Okay. First one under capital, you do one thing, you wrote capital structure ratios, right? In bracket, you write long-term solvency ratios. Long-term solvency. And here you can write ability to meet fixed liabilities. Long-term solvency ratios and their ability to meet fixed liabilities. Okay. Then put a heading capital structure ratios. Below that, we'll write one by one. Capital structure ratios, put a heading, and below that, we'll write. Guys, do one thing. So, long-term solvency position. Okay, just write this long-term solvency position. Okay, this tells us long-term solvency position. Here it tells us the ability to meet the fixed liabilities. Okay, then put a heading capital structure ratios. Below that, we'll write one by one ratios one by one. Capital structure ratios. First one is equity ratio. Equity ratio. Equity ratio is equal to shareholders equity divided by net assets. Equity ratio is equal to shareholders equity divided by net assets. Okay, put it in a box. We'll write what is each of them. What is shareholders asset? What is net equity? We'll write that. First one, where shareholders equity is equal to shareholders equity equal to equity share capital plus reserve surplus excluding fictitious assets. Excluding fictitious assets. You know what is fictitious asset? Fictitious asset, heard about it? Yes. What is this thing? What? Contingent. Imaginary. Okay. So guys, okay, you write this first. Equity ratio is equal to shareholders equity divided by net asset. Shareholders equity means equity share capital plus reserves and surplus excluding fictitious asset. So fictitious asset is not real asset. It is more of an imaginary. These assets are the assets that is sheet because that can be put anywhere else. This is not real asset. Some is brought to the balance sheet because it can be put anywhere else. That is, it doesn't have any value. It is simply put in asset side because it can't be put anywhere else. Example. You have heard about preliminary expenses. There is something called preliminary expenses, or you call it pre-incorporation expenses. Okay, this is pre-incorporation expense. Say for example, you are starting a company. To start a company, you have to go to a CA. He will give you so many details. You have to give so many details. End of the day, CA will incorporate the company and give. CA will charge a fees. Say for example, he charges a fees of 25,000 rupees. Company not even started. Before that, we started incurring expense. These kind of expenses which comes before incorporation, pre-incorporation, we call it preliminary expense. Now what happens is, ideally this should have been put in profit and loss. There was no much story, but the companies have said no, you can't do this. Companies have said this particular whatever preliminary expense, you to split it into 5 pieces. Each of the 1/5 charge it to P&L. The Companies Act said, whatever preliminary expense you have, you can directly put it in P&L and close it. Not allowed. Companies Act says what you do is one P&L for every 5 years, then you do. Then it will be over. So first year 1 May, you charge one P&L, which means 5,000 you charged in, then you have 4/5. This you can't put in P&L. Our only option is in balance sheet. In balance sheet, this is not a liability. This is already paid off. It's not a liability. It's more like a prepaid asset, you would say. But this is not even a prepaid asset. It's already incurred, already gone. It's more of a sunk cost. There's nothing to do now. So what to do? Balance sheet asset side and call these kind of assets fictitious assets. So preliminary expense or pre-incorporation expense is more like a fictitious asset. So it is not actually a real. It's not something of real value. It is simply put in balance because it can't be put anywhere else. The Companies Act has asked us to do it. So one of the. So don't consider these kind of items for shareholders' equity. If there is some items, just ignore it. Okay, exclude it. Then net assets. What is net assets? Guys, net asset, we call it by another word called capital employed. Heard somewhere? We did in some in capital structure, if you remember, we used this term. So capital employed or net asset are the same thing. This is basically net fixed asset, plus net working capital. Okay, net asset means, or capital employed means, net fixed asset plus net working capital. Net fixed asset plus net working capital. Net asset means, or capital employed means, net fixed asset plus net asset means net fixed asset plus net working capital. Guys, net fixed asset means fixed asset minus depreciation. So on net basis, there is some places where you do a gross fixed asset and depreciation, then you take net. So this is that net. Fixed asset, gross fixed asset minus depreciation, that is net fixed asset. Gross fixed asset minus depreciation, that is net fixed asset. And net working capital, you already know what? Current assets minus current liability. Okay. And the net working capital, we call it by another word name called net current assets. Net current assets means the same thing. Net working capital and net current both mean the same thing. So many terms, guys, here. Please remember, okay? Equity ratio is equal to shareholders' equity divided by net asset. Shareholders' equity means equity share capital plus reserves and surplus, but exclude because fictitious generally reserves and surplus sometimes. So just ignore it, remove it, and take it. The net asset means or capital asset or capital employed, both can be computed by using net fixed asset plus net working capital. Net fixed asset means gross fixed asset. Net working capital is also called as net current assets. Okay, you have to know all of them. Okay, so this one formula means you know all these formulas inbuilt or all the terms. So this is equity ratio. Okay. So guys, here what this will give you, the total net asset. Okay, in balance sheet, we are not talking about total asset, we are talking about net. The net is funded by equity. That is what this ratio will give. So how much of the net is funded by equity and how much of the fund is funded by funds? If you know, if say for example, this is 10%, this is 10%. This is not a very good scenario because we want equity shareholders to have some. So shareholders should have more assets. So this particular ratio will tell you, okay, shareholders is holding less, something problem here. Okay. or shareholders is increasing, having more also problem, having less also problem. We have to somewhere see what is the balance depending upon the industry, depending upon the company scenario. Okay, there is no defined percentage. It simply says this will give you a picture how much of the assets is funded by equity shareholders, is funded by someone else. Okay, that is what this particular ratio. Next one, debt ratio. Debt ratio. Debt ratio. Debt ratio is equal to total debt divided by net asset. Debt ratio is equal to total debt divided by net assets. Total debt divided by net assets. Total debt means all debt, short term, long term, everything added. Okay, net assets means you already know what is net asset. Net fixed asset plus net working capital. Net fixed asset means what? Gross fixed asset minus depreciation. What is net working capital? Current assets minus current liability. Okay, all this you should know. So this will give you this ratio. Debt ratio will tell you how much of the net asset is funded by debt. If too much funded by debt is a problem, again this also will help you make decisions. Okay. Now next one, debt to equity ratio. Debt to equity. Debt to equity. DBT TO equity. Equity ratio. Guys, fictitious asset, if you want to write an example, write example as preliminary expense. Okay, fictitious asset. Debt to equity ratio. Debt equity ratio is equal to what you do is debt equity ratio is equal to total debt divided by shareholders debt divided by equity. Total debt divided by shareholders equity. Write this. Total debt divided by shareholders equity. Total debt divided by shareholders equity. Simply debt equity ratio is debt divided by equity. Debt equity ratio is debt by equity, but if something else come, it will vary, guys. Here only in the textbook only they have told this total debt can be sometimes long-term debt only. So depending upon the scenario, this will vary. But if you simply plainly ask what is debt equity ratio, debt divided by equity. Okay, debt divided by shareholders equity. You know what shareholders equity is? What is shareholder equity? Share capital plus reserves and surplus excluding fictitious asset. Okay. Okay. Now, guys, debt to equity ratio. Debt to equity ratio. So, guys, this ratio will tell you how much debt do you have compared to equity. Say there is 100 lakhs equity and 200 lakhs debt. This is tell you the company has more debt compared to equity. So this will give you a comparison of debt to equity. So too much debt is a problem. Too much equity is also a problem. So you will use even this ratio to make a decision. Okay, you'll see whether it is too debt-ridden company, it's difficult. Okay, they might not be able to repay it. But too less debt also a problem because we can't use the tax benefit. So you have to balance these two. So debt equity ratio will help us. Okay, in identifying how much debt is there in relation to equity. The next one, debt to total asset ratio. Debt to total asset ratio. Debt to total assets ratio. Debt to total asset ratio. Guys, if you see a TO in between, always before one, after less. If you see debt to equity, above will be debt, below will be equity. Here also, debt to total asset. What will be the formula? Total debt divided by total asset. So that's a formula. Total debt divided by total asset. Total debt divided by total asset. So guys, if you see some new formula which they invented and they give you 2 0 in between, 3 0 in between, you just take First one divided by second one. Okay, that's all. You need not think anyway. Just to take first one divided by second. Okay. So here debt to total asset ratio is equal to debt divided by total debt divided by total assets. So guys, what is the difference between debt to total asset ratio and debt ratio? In debt ratio, we took a net asset. Here we took a total asset. What is the difference? Net asset is net fixed asset plus net. What is net asset? Net fixed asset plus net working capital. Net fixed asset was net gross fixed asset minus depreciation, and net working capital was current assets minus current liability. But here it is total asset, no drama. Directly total asset. There is nothing else to do. Okay, that is debt to total asset ratio. So this debt to total asset will tell you out of the total asset how much is funded by equity or how much is funded by debt. This will give you that picture. Next one, capital gearing ratio. Capital gearing ratio. Capital gearing. Capital gearing. Capital gearing ratio. Okay. Is equal to preference share capital. Preference share capital plus debentures plus other borrowed funds divided by equity share capital plus reserves and surplus minus losses. Guys, capital gearing ratio. Guys, this ratio essentially what is the proportion of external borrowed fund compared to equity share capital. If you see denominator, this is equity share capital, shareholders equity. Normally this is all same. This is just structured. Basically this is equity shareholders equity. It's nothing same. Like equity share capital, reserves, surplus, losses. Anyways, we'll consider it that way only. Normally shareholders equity would mean the same thing. Hello? Okay, so guys, capital gearing ratio, this denominator is basically equity share capital, numerator is basically external. So if there is preference share capital, if there is debenture, if there is other borrowed fund, what we are looking at is how much percentage is external fund compared to internal fund. So what percentage of or what is the proportion of external fund to internal fund? Preference share capital is generally considered as external fund only because you have a fixed sum. Debentures have a fixed sum. Current other borrowed fund has a fixed sum. Okay, compared to the equity portion. This is basically equity share capital, shareholders equity only, just structure. Okay, so this will give you what is the external fund proportion compared to internal. Okay. Like this, preference share capital plus debentures plus other borrowed fund divided by equity share capital plus reserves and surplus minus losses. Last one in this section, proprietary ratio. Proprietary ratio is equal to proprietary fund divided by total asset. Proprietary fund divided by total assets. And what is proprietary fund now? Proprietary fund is equal to equity share capital plus reserves and surplus plus preference share capital. Equity share capital plus preference share plus reserves and surplus plus preference share. Okay, proprietary ratio is equal to proprietary fund divided by total asset. Proprietary fund is equity plus reserves, preference share capital plus reserves and surplus. So basically, this proprietary ratio will give you the information of how much of the total asset is owned by proprietors or equity and preference combined. What this ratio will give you. Okay. So these are the what ratios? Capital structure ratios. Capital structure ratios. We'll do the next section, coverage ratio. Next section, coverage ratio. Coverage ratios. You can write below. These ratios measure the firm's ability. These ratios measure the firm's ability. These ratios measure the firm's ability to service, SCRVIC, to service the fixed liabilities. Service the fixed liabilities. Okay. Okay, so guys, here what will happen is, so we have so many fixed charges. We have charges like debenture interest, like preferential capital, equity share capital, all this we have. We have a lot of, we have used. Now, these ratios will tell you whether we can meet these particular, we can meet these, like how good are we in meeting the returns that needs to be given to these people. Example, let's talk about interest coverage ratio. Interest coverage ratio. Coverage ratio. Interest coverage. Who will, what will be the, will you pay interest? Debentures. Debentures, you will pay from which amount? EBIT. You will pay from EBIT divided by interest. So interest coverage ratio basically tells us how many times EBIT do you have to meet the interest. How many times of EBIT do you have it? Say for example, you have 10 lakhs as EBIT and interest is say 1 lakh. Means you can meet the interest, ability to meet the interest 10 times. Currently only 1 lakh is required, but you, even if still will be able to meet. That is what this coverage ratio will mean. Right below, coverage ratio. Interest coverage ratio. Interest ratio. Interest coverage ratio is equal to EBIT divided by interest. Interest coverage ratio is equal to EBIT divided by interest. EBIT divided by interest. Next one. Preference dividend coverage ratio. Preference dividend coverage ratio. Preference dividend coverage ratio. Preference dividend coverage ratio. Guys, you tell me what it will be. EAT, guys, from EAT is what we pay, divided by preference share dividend, not number of shares, preference share dividend. Okay, EAT divided by preference share dividend, because from which number do you pay? We pay from EAT. EAT minus preference share dividend. That is what we normally do. So preference dividend coverage ratio is equal to EAT divided by preference share dividend. Preference share dividend. Okay. Similarly, next one, equity dividend coverage ratio. Okay. So equity dividend coverage, how will you find out? EAESH divided by equity dividend. EAESH divided by equity dividend. Okay, then you can write below next ratio. It is called debt service coverage ratio. Debt service coverage ratio. Guys, debt service coverage ratio, we call it DSCR. Okay, debt service coverage ratio. Let's write the way. Okay, earnings available for debt services. Earnings available for debt services. Earnings available for debt services divided by interest plus installments. Interest plus installments. Okay. So, guys, DSCR is earnings available for debt services divided by interest plus installment. Guys, there is too many variations to this formula. Sometimes what happens is you take EBIT in numerator. Okay. Sometimes you take EAT, interest plus non-cash expense. You take cash profit. So there are so many variation that we use here. In general sense, what I can give is this is something IT, okay, or EBT. Even tax is not required here. Is some, but I've just given it like this. That's why. And interest plus installment. There are so many variation. First is interest. Interest, you know what it is. Installment. Now installment can mean so many things. Install can mean EMI. You took a loan. There is EMI. Now EMI has two portions. One there is interest. One is there is principal. So some places there is installment. Some places it means EMI. Sometimes it means principal repayment. So there are many variations. So depending upon what is given, you can use this. Okay. But this is one of the important formulas, guys, not for our exam standpoint. This is important when you actually go for practice. If you would have involved in any new company formation or new loan, if you not home loan, any business loan, if anybody would have gone, like any of your parents or relatives or friends or anybody has gone for loan to a bank, they will ask something called a project report. I don't know whether you heard. There's something called project report. Project report is nothing but estimation of next few years. Okay, it's more like a estimation. Say, for example, you are starting a pen business. What they will ask you to, what project report will have is, okay, this person, first they'll give you a background of you. This is Mahesh. Mahesh is doing this. He's a chartered accountant. He did practice, blah, blah, blah. He'll give a brief. Then what we'll do is we'll do an estimation of next 7 years. This is his plan. So this much fund will be required. Then we'll give an estimation, proper P&L and balance sheet will give. Okay, we'll have details of this year, this much will be sales. This sales will increase so much. Then there will be those so many expenses. This expense will be so much and this will increase at this rate, blah, blah, blah. Next 7 years balance sheet P&L will give them. So it's more of a projection. It is more of a project report. Whenever you go to a bank for a business loan, they'll ask for a document like this project report. So this project report, most bank requires it to have some formulas. One of the major formulas is this DSCR. This will even include current ratio, quick ratio, debt equity ratio. All these ratios will have, but this is one of the ratios which a bank look very clearly because they want to know. Let's forget about what like EBIT, EBT. Let's forget about all those. So they want to know whether you have enough money to repay their interest and principal. Okay, bank is interested to know whether you have enough earnings to meet the interest payment, EMI payment. That is what the bank want to know. Okay, so do you have capability or how much extra capability? Say 100 lakh, interest payment is only 5 lakh, and EMI, the principal repayment comes up to only 5 lakh. So now here 100 by 10 lakh, which means you have 10 times capability to pay their interest in. So bank will be happy. So they would want you to have a high DSCR. Okay, generally DSCR of 2.5 and above is generally considered okay. Okay, less than that bank will be worried. So bank generally looks for this particular ratio. So whenever we prepare the project report, they generally come to a practicing CA. So we prepare it normally. So when they come, this is one of the major ratios which the bank asks us. So only if it is DSCR, they will proceed with the loan. Otherwise, they won't give the loan. Exact standpoint, I've not seen it asked any time, but the practical standpoint, this is used important as in a work, not in the exam scenario. But this DSCR is equal to earnings available for debt services divided by interest plus installments. Then you can write below what is earnings available for debt services. Earnings available for debt services is equal to earnings available for debt service is equal to EAT is equal to EAT is equal to EAT plus non-cash expenses, non-cash operating expenses, non-cash operating expenses, EAT plus non-cash operating expenses. In bracket you write depreciation. In bracket you write like depreciation, bracket close, plus interest, plus interest, plus interest, plus other adjustment, plus other adjustments, plus other adjustments like loss on sale of fixed asset, like loss on sale of fixed asset, etc. Okay, so earnings available for debt services, this is the formula that they've given: EAT plus non-cash operating expense plus interest plus other adjustment. So basically this is the profit before paying debt. Okay, earnings before payment of debt. So this earnings in any scenario does not include. So this means before paying debt, how much is your earnings? They call it after tax. They ask us to add the interest. They ask us to make adjustment for everything else. So this is basically before paying interest, what is your earnings? Before tax, after tax, different story. Then how much you have interest, I mean, if you can meet, that's it. Okay, so this is DSCR. Okay. Then there is one more ratio. Next one, last ratio in this section. Fixed charges coverage ratio. Fixed charges coverage ratio. Fixed charges coverage ratio. Then write fixed charges coverage ratio is equal to fixed charges coverage ratio is equal to EBITDA. EBITDA. So basically, this is cash earnings, not a non-cash. It is cash earnings. EBITDA divided by interest plus repayment of loan. Fixed charges coverage ratio is equal to EBITDA divided by interest plus repayment of loan. Again, repayment of loan, if not very clear. It can be the BEMI, it can be principal amount depending upon the scenario. Okay, not general in the exams. These, okay, DSCR, interest coverage, not. So then this category is over, guys. Okay. You have enough formulas to study now? Now you can study for some time. Need a break also? Yes, sir, very much so. Okay, we'll take a break. Do you want to study and take a break, or you want to take a break and then study, or you want to study in the break? Okay, let's take a break now. It is 11:41. We'll come back at 11:55. Okay, we'll come back at 12, but I assume you'll study by then. No? Then you come at 11:55. We can study 5 minutes till 12. I mean, you want to eat food? Okay, you come back at 12. No problem. Come back at 12. Then we'll study. Okay, come back at 12. I'll give 5 more minutes after we come. Okay, come back at 12. Huh. 12. We started at 12. ಸ್ವಲ್ಪ ಫಾರ್ಮುಲಾಸ್ ಬಾಕ್ಸ್ ಅಲ್ಲಿ ಹಾಕಿ so that you will know that formula. ಸ್ವಲ್ಪ ಬಾಕ್ಸ್ ಅಲ್ಲಿ ಕಳಿಸಿ. ಅಲ್ಲಿ ಥರ್ಡ್ ಫ್ಲೋರ್ ಒಂದು ಬೋರ್ಡ್ ಕಾಣಿಸುತ್ತೆ. हाँ वही वहाँ पे एक ब्रिक्स वाला बोर्ड दिख रहा है आपको, वहाँ से वो वहाँ से वो स्टेज है ना, वहाँ से आते ही थर्ड फ्लोर वहाँ का ब्रिक्स. हाँ वही 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 ऊपर आ जाइए, थर्ड फ्लोर है. हाँ थर्ड फ्लोर आना है. उसके नीचे आपको पार्किंग नहीं चाहिए तो अंदर बस. हाँ कर दो उसके नीचे आ जाइए, वहाँ पार्क करके लिफ्ट में लिफ्ट लेंगे थर्ड फ्लोर. हाँ थर्ड फ्लोर हाँ. ಆಯ್ತು. ಆಯ್ತು ಓಕೆ. You have one doubt in formula. Okay, tell me. I don't know what is the formula. Why this is like that, or what kind of That's what I'm telling you. Here, I can't completely tell you. Then there is tax one. So EBITDA normally has in tax before tax, right? This is tax. Oh, so you can't simply say it is EBITDA directly. That's what a little a no tax, then probably somewhere close. EBITDA. Will come sometime. Okay. You're going. Tada. We'll miss you. Okay, tada. Tell us. Okay, bye. Okay, she somehow escaped from questions. Okay, 5 times. Okay, you can close it now. ಸ್ವಲ್ಪ ಕ್ಲೋಸ್ ಮಾಡಿ ಹರಿ ಸ್ವಲ್ಪ ಕ್ಲೋಸ್ ಮಾಡಿ ನಾಗೇಶ್ ಸ್ವಲ್ಪ ಕ್ಲೋಸ್ ಮಾಡಿ ಅಶ್ವಿನಿ ಸ್ವಲ್ಪ ಕ್ಲೋಸ್ ಮಾಡಿ ಡೋಂಟ್ ಕೀಪ್ ಬುಕ್ ಇನ್ ಬಿಟ್ವಿ ಹಾ earlier it was pen now it is book ಬೇಡ ಪೆನ್ಸಿಲ್ ಬೇಡ ಓಕೆ ಬೇಡ ಯಶವಂತ್ ಕ್ಲೋಸ್ ಪೆನ್ ರಿಮೂವ್ ಮಾಡಿ ರಿಮೂವ್ ಮಾಡಿ ಆಯ್ತು ಓಕೆ I'll start from Chinnu just like before. You did not read only. Why? Too much formula, sir. So I can't even retain one formula. Okay, we'll start. Current ratio. Net working capital. Net working capital. Okay. Net fixed assets. Mm. Okay. Net assets. Net assets. ಐದು ಸಲ ನೆಟ್ ಅಸೆಟ್ಸ್ ಐದು ಸಲ ನೆಟ್ ಫಿಕ್ಸ್ಡ್ ಅಸೆಟ್ ಪ್ಲಸ್ 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 no you tell me now you net working capital guys gone ಹರಿ ಸ್ವಲ್ಪ preference share preference dividend coverage ratio EAT divided by think you need to cover what preference dividend from which number where will you pay preference dividend from ಗೊತ್ತಿಲ್ಲ ಐದು ಸಲ ಸಾಕು ಐದು ಸಲ ಮುಳುಸೆ ಪಂಡೆ preference dividend what preference dividend coverage ratio EAT by preference dividend ಅಷ್ಟೇ from where did you pay preference dividend from EAT equity dividend coverage ಗೊತ್ತಿಲ್ಲ equity dividend coverage did not see only equity dividend cover ಸ್ವಲ್ಪ EAESH divided by you will kill you divided by don't ಐದು ಸಲ 10 ಸಲ ಹೇಳಿ divided by equity shareholders okay ಐದು ಸಲ guys dividend equity dividend ಮುಳುಸೆ we'll start from DSCR dividend service not dividend sorry debt service coverage ratio earnings available for debt services divided by interest plus installments okay ನಾಗೇಶ್ ಸ್ವಲ್ಪ ಹೇಳ್ಬೇಕು what else did we have give me one ಸ್ವಲ್ಪ ಬುಕ್ ಕೊಡಿ ಡೋಂಟ್ ಓಪನ್ ಅಂಡ್ ಚೆಕ್ ಎವ್ರಿವೇರ್ ಡೋಂಟ್ ಚೆಕ್ ಐ ವಿಲ್ ಚೆಕ್ ಕ್ಲೋಸ್ ಮಾಡಿ ಹೂಎವರ್ ಓಪನ್ಡ್ ಕ್ಲೋಸ್ ಮಾಡಿ ಡೆಟ್ ರೇಷಿಯೋ ಅಷ್ಟೇ total debt divided by total come again what is debt total debt divided by net assets What is net asset, Ashwini? Fixed asset, net working capital. Okay. Proprietary risk. What is proprietary? Okay, repeat what is ratio? Total assets. Sure. Hmm. Debt equity. Hmm. Compute shareholders equity or equity. Simply, how will you compute equity? How can we compute equity? Shareholders equity is equal to ಹೋಯ್ತಾ ಎಲ್ಲಿ ಹೋಗಿದೆ ಎಲ್ಲಿ ಹೋಗಲ್ಲ 5 ಸಲ ಅಗೇನ್ 10 ಸಲ ಆಯ್ತು ಓಕೆ ಹೌ ಡು ಯು ಹೌ ಟು shareholders equity how do you compute shareholders equity 5 ಸಲ ಅಗೇನ್ years 5 ಸಲ there are already 5 ಸಲ how do you compute shareholders equity guys 5 ಸಲ ಹೇಳಿ equity share capital equity share capital plus reserves and surplus mandamar full forgot then excluding fictitious assets okay guys full hoytu yeshwant what is capital employed ಗೊತ್ತಿಲ್ಲ 5 ಸಲ 5 ಸಲ 5 ಸಲ okay tell me what is capital employed equity share capital plus reserves and surplus okay or this is something which we learned in last chapter this chapter also we learned capital employed that I'm not that is correct not me there is one more formula I want guys 5 ಸಲ again you again 5 ಸಲ question capital employed how will you compute capital employed that's it don't talk Yeshwant I will do again 5 ಸಲ ಹೇಳಿ ನಾಗೇಶ್ ಹೇಳಿ you know equity share capital plus okay I am not saying this is wrong this is correct I agree with you but I want one more formula one more don't know no you know guys net asset is called capital employed same thing which means net fixed asset plus net working capital ashte net asset is also called as capital employed we wrote in bracket also okay so you can compute reserves and surplus equity that also correct no not wrong I'm saying this is also same thing it's also a formula don't write 5 sala that's okay but you have to remember capital employed and net asset same thing okay equity ratio is equal to shareholders equity divided by total you decide a shareholder okay equity ratio is equal to shareholders equity divided by I will give you one more chance okay equity ratio is equal to shareholders equity divided by correct okay that is correct only okay I'm not denying munuse ಸ್ವಲ್ಪ ಹೇಳಿ what is fixed charges coverage ratio fixed charges coverage ratio ಗೊತ್ತಿಲ್ಲ 5 ಸಲ fixed charges coverage the last one we wrote If you remember, last one. Hari Gotu, Heli. EBITDA divided by interest plus repayment of loan. Okay. Oh shit! I knew that. Okay, I will give you another one. Who is that shit? Shit. Okay, I'll give you. You, him. Him. Okay, I will give you. Oh shit! It seems. What is basic defense interval? Heli. Oh shit, Heli. Basic defense interval. Basic defense interval. Huh? Basic defense interval. What divided by? What is up? What divided by? Tell me. Basic defense interval. Cox. Sales administration expenses minus minus what was their depreciation divided by number of days. This is what? This is basic defense interval. Guys, this is daily operating expense. This is not the basic. You how many idu salas I will write. Ashini ಸ್ವಲ್ಪ ಹೇಳಿ basic cash in bank plus receivables, okay, plus marketable securities divided by daily cash operating. That is what you said. Daily cash operating expenses. Whatever you said. Not different. Hari, ಸ್ವಲ್ಪ acid test ratio ಹೇಳಿ. Acid test ratio. Acid test ratio. Quick assets divided by How do you find out quick assets? Current assets minus inventory minus prepaid expense. Cash ratio. Prepaid expenses minus inventories minus cash and bank. I'll give you one more chance. Okay. I asked you what is cash ratio. From cash and bank, what minus? From current asset, we minus so many things. Not cash. Or you add cash and bank balance. You did the cash and bank balance minus. They're wrong. Gone. Shit. Tell me. You are the shit. Tell me. Tell me. No, I will ask you. You tell me first. I will ask you separately. Which one was? Which one? Cash ratio. Heli. Cash. Cash ratio. Cash. Okay, cash. Kuda. Heli. Cash ratio. Heli. Aidu sala again. How many Aidu sala now it became? 20. Okay, some 20 times. Monu sir. Tell me acid test ratio. Acid test ratio. You don't talk, Acid test ratio. I will talk. Acid test ratio. Acid test ratio. Not acid. Sulfuric acid. Hydrochloric acid. You remember? In 10th standard, you had some acid. Same acid. Acid. You keep quiet. You tell me. Gotila. Aidu sala. You can tell me. Quick acids divided by current liability. What is quick acids? Quick assets. Current asset minus prepaid expenses minus inventories. Okay. Did we forget something? Proprietary ratio. Total asset or net asset? Total asset. How to find out proprietary fund? What is proprietary? Preference share. Okay. Okay. Yashwant. What is capital gearing ratio? Capital gearing ratio. Preference share capital. Plus debenture plus other borrowing divided by plus the plus minus losses. Okay. Okay, I think that should be enough for now. Okay, so many Aidu salas. So guys, what you do is don't write Aidu Salah 5 times, 100 times, and all. Whoever has to write, everybody write it 2 times. All of you guys, doesn't matter. Okay, everybody write it 2 times. Entire formulas. Okay, in small formulas also you need to write. Whoever told me answer, not told me answer, doesn't matter. Everybody has 2 times. Okay, and show me tomorrow. Show me tomorrow in the next class. Okay. Let's do some question, guys. Even I got bored. Okay, let's do some question. Question number 2. Question number 2. Page number, you guys tell me. 4, 3, 3, 3. 3 or 4, I don't know. You take the number. Page number 2 or 3 or 4. You decide. Okay, 3 and piece. Okay, piece 2 and 3 then. Okay, 3 and 4. Sorry, 3 and 4. You can't open 4 and 5 together, right? You can open only 3 and 4. You open that and keep. Okay. Let's go to question number. The is the sum is a form cell component to net worth. Okay. We did not write. So guys, that we wrote here. We did not write, right? Yes, we wrote equity share capital plus surplus. So guys, we have written shareholders equity, right? In bracket, you write that is basic our net worth. You write separately. You write separately. No problems. You write separately. Net worth is equal to net worth is equal to net worth is equal to equity share capital surplus. Net worth is equal to equity share capital plus surplus. Or you write below net worth is equal to total assets minus total liabilities. So we have two formula. Either you take total asset minus total liability, or you take equity share capital plus reserves and surplus. Okay. This is holders equity only. End of the day. Okay, same. Okay, guys. So given sales to net worth, current debt to net worth, total debt to net worth, current ratio, net sales to inventory, fixed asset to net worth. So everywhere you see a 2, which means all by second thing. So they have given so many ratios. There is a pro forma balance sheet given. You just have to fill the numbers. Let's do this together. Next loan. Okay. First, guys, question number 3, right? 2, right? Okay. They have given sales to net worth. Okay, I'll just write what they've given. Then we'll see what to do. Okay. Sales divided by net worth. How much? 2.3. Next, what else have given? Current debt to net worth. Okay, how much? 42%. Let me write 0.42. Okay, easiness. Next one. Total debt to net worth. How much? 0.75 or 75%. Next. Current ratio, you know what is current ratio? Current assets divided by current liability. Okay, how much? 2.9. Okay, next, what else is given? Come again, sorry. Net sales to inventory, how much? 4.7. Anything else given? Fixed asset to net worth, how much? 0.532, 53.2%. Okay, anything else given? Okay, and they have given a pro forma balance sheet. You fill in the balance sheet. Tell me what are the available. Net worth, basically this is equity share capital. Okay, net worth, then long-term debt, current debt, and that's it. Okay, then what? Stock. The numbers. This amount given, how much? 16 or 60? Okay, 5,68,000. 5,6,889. Okay, anything else given? That's it. And do we have the balance sheet total? No, nothing given. Okay. And sales given? Sales given about 32. Okay, sales also given, it's 32 lakhs. Okay. So guys, what you have to do is you just have to, you have so many ratios, use those to fill the balance sheet. Let's start from here first. Sales divided by net worth. You know sales, you will get the net worth. So from here, guys, net worth, okay, is equal to sales divided by 2.3. Correct? Net worth goes here, 2.3 came down. So this here from here, net worth is equal to how much? 32 lakhs divided by 2.3. How much is this? 13,91,304.3. Okay. Now I can fill the balance sheet. So what you do is this kind of question comes. First you draw the pro forma balance sheet. Keep it there. Leave some space. Then you do all the computation, fill it and link it to working notes. Working note 1, 2, 3, 4. Okay. So first one. So 91. Then from okay. Now can we use this find out current debt? Possible because we know net worth. From here, guys, current debt is equal to what can I do? 0.42 into net worth. Correct? Gets multiplied. From here, guys, current debt is equal to how much? 0.42 into 13,91,304.3. How much? 348. There is no points and all. Okay, let's leave the points. Let's keep it 0. Okay, this is 348. Okay, I'll keep this, leave this one. Okay, this is okay. So we go. Let me fill this. 5,84,348. Then total debt. Here also we can find out total debt. Total debt is equal to 0.75 into net worth. Okay. Help me. This is 0.75 into what is the net worth? 13,91,304. How much is this? 10,43,478. So this second, can I? No. Total debt means long term plus current. This you already know. From here you will get the long term debt. How much? From here, guys, total debt we have 1 minute. Total debt we have. So long term debt plus short term debt or current debt is equal to 10,43,478. From here, long term debt is equal to 10,43,478 minus 5,84,348. How much is this? 59,13. This now 4,59,130. Can you give me a total? How much? Total. 23 lakh. 24 lakh 782. Okay. So this has to be same here also. 24, 34, 782. This much is okay. Now let's come here. Current assets divided by current liability is equal to 2.9. Do we know what is current liability? Guys, there is only one item in current liability. So we know. Because this is not part of current liability. This is not part of current liability. This is part of current liability. You know what current liability is. So only this is available. So we're taking only that is available. So from here, guys, current assets is equal to 2.9 into current liability. Okay, from here 2.9 into what is current liability? 5 lakh 84,348. It's 4, okay? 4. Tell me how much is current assets? 2.9 into that number. 609. This is okay. Now, can I fill this somewhere? I can fill it. I can fill that as a total of these three. These three total should be so much because these three are forming part of current assets. So all these three put together should come to so much. Either you write it here 16 lakh 94,609. Okay, 609. This much is okay. Then net sales to inventory. From here, can we find out inventory? We already have sales. Net sales means sales, nothing new. So from here, guys, inventory is equal to net sales divided by 4.7. From here, net sales, how much? 32 lakh divided by 4.7. How much is this? 0.85. Is this the number? Okay. So can I fill this here? Stock. 6 lakh 80,851. Now can you compute cash? It will be a balance figure. Can you compute the cash? This minus this minus this. 4 lakh 44,869. Okay. Then now you can either find the balancing figure here or you have this also. You can even use from here fixed asset is equal to 0.532 into which is 0.532 into what is net worth? 13,91,304. Can you tell me this? How much is this? 7 lakh 12,008. 7 lakh 40,174. It's okay. 1 rupee you take it. Go home. Okay. Fixed asset, we get 7 lakh 40,174. Guys, is this matching or 1 rupee difference is there? Keep it 3 there. Okay, 1 rupee difference comes, we'll make it as 3. Okay, no problem. That's it, guys. This is how exam question comes. Do it. Okay. This is question number 2 for you. got the key. Then with the you draw the balance sheet structure first. Then you do everything. Then you put the right working note number in each working note and link it to the main balance sheet. Because the examiner want to see the answer first. Just draw the structure, leave some space, then you do it. And guys, in this chapter, a lot of assumptions. Okay, we make assumption that this is zero, that is zero. So many things we do. Urgent funds. These people. Calls as if they don't want me to repay. But then one time they called me, then I asked, every time they keep calling and asking me, sir, loan is available, loan is available. Then I asked one time, so I took the call and asked them, do I need to repay? After that, she never called. Okay. Every time I block that, they call from a different number. I have some 150 blocked list now. Is done? Not yet. Okay. Simamaitu. Over. Okay. Have one more in there. Take the biscuit. Give me the cover. Take and give me the cover. There's so many people left. Got 3 biscuits left. 2 people are on leave. How many are on leave? 1, 2, and 3 total. Okay. 3 people are on leave. Okay. Biscuit? No, you don't eat biscuit. Why? You're fasting today? No. Then eat. Okay. Sleeping? She's sleeping, is it? You can give one to her, okay? Or whoever is here. You keep it like this. Hmm? Okay. Now you can do some questions. Okay. Let's do question number 10. Question number 10. Question number 10. ABC Limited. This is September 2025. 1 mark question. Okay, 1 mark. ABC Limited gives you the following information as on 31st March 2025. Current liability 1,60,000. Current ratio 2.5. Liquid ratio in bracket quick ratio is equal to 2. What will be the value of stock? Find it out. Question number 10. One mark question. Decent question. So they have given current liability and they have given ratio, and they have even want you. They have given quick ratio. I mean, want you to find what quick ratio? Stock they want you to find out. Current ratio given, quick ratio given, current liability given. You have to find out stock. How much? 80,000. Okay. So guys, whatever assumption that you need to make to the solve the question, you can make the assumptions. Okay. Here we assume there is no prepaid expense because nothing told. So whatever not available, just assume as 0. You know, one more question, but if you want on a safer side, you can make an assumption, no problem. But here and all not required, just 1 mark. Doesn't really matter. Multiple choice question also. So anyways, they would have given 2, 3. I do it. How much? Got it. Guys, how much is the current assets? 40,000 or 4 lakhs. Then from there you will get a quick ratio. Quick ratio, you know, current assets prepaid expenses minus debtors. Not debtors, sorry, minus inventories. So prepaid expense will assume it is 0 because not getting told about it. So you can do current assets minus stock divided by current liabilities is equal to your quick assets. I mean quick ratio. From there you cross multiply, get the answer. It is 80,000 rupees. Tamil aitu. Arvind. Arvind ಆಗ್ಲಿಲ್ಲ ಮಾಡ್ತಾ ಇದ್ದೀನಿ ಓಕೆ ಆಯ್ತು ಮಾಧವನ್ ಕಾವ್ಯ ಅಶ್ವಿನಿ ಆಯ್ತು ಚಿನ್ನು ಆಯ್ತು ಲೆಟ್ಸ್ ಮೂವ್ ಫಾರ್ವರ್ಡ್ ಗೈಸ್ ಯಶವಂತ್ ಆಯ್ತು ಆಯ್ತು need help guys, anybody want me to do it on board? Required, please tell me. Don't feel shy and all, just raise your hand, I'll do it. Okay, we'll move forward then. Let's do question number 3. Let's do question number 3. After doing this, we'll go back to theory again. Okay, we'll just finish this question and we'll go back to theory, or we'll go back to more formulas. Question number 3. From the following information, summarize the statement of assets and liabilities as on 31st March 2017. Working capital given, reserves and surplus given, bank OD given, fixed assets to proprietary ratio given, current ratio given, liquid ratio given. Liquid ratio is basically quick ratio. Okay. Then your working should form part of answer. You need to find out, guys. One more thing here. There is fixed asset to proprietary ratio, right? That means fixed asset to proprietor's fund. Okay, not proprietary ratio. This is fixed asset to proprietary ratio, means fixed asset to proprietor's fund. Okay, just assume that, because here if you take proprietary ratio, again you will put that formula, proprietor's fund divided by, then it will become divided by, not that. Fixed asset divided by proprietor's fund, that's what it means. You can do it, right? So we need to draw a balance sheet. So just assume, guys, just 1 minute. If they ask you to do the balance sheet, your basic assumption is balance sheet will have these many things. Okay, balance sheet should have a fixed asset, it will have a current asset, it will have a current liability, equity share capital. This much at least has to be there in a balance sheet. Apart from this, it's okay. Current asset might have so many breakups, okay, and even current liability might have so many breakups. Fixed asset might have breakup. Equity share, there may be debt, there may not be debt, or there may be preference share capital, depending upon the scenario. But in basic, this much should be there in a balance sheet. Okay, under this you add based on the quest. Okay, assume the rest is not there. Okay, do it. So these four figures has to be there in a balance sheet. So what you can do is you can just simply draw balance sheet and leave spaces, and then you can later you can see. Then you can do the question, like whatever is required, then you can carry forward. How much is current assets? 50,000. Current liability? 50,000, 20,000. Something wrong. Check again. 80. How much? No, current liability how much? Current assets how much? That much is okay. So mathematics nodi. NI2. One minute. NI2. Where did you go wrong? Okay, current ratio is equal to current asset divided by current liability. Okay, 2.5 is equal to current asset. What is current liability? Where do you get 20,000? Who told you that's current liability? You can't take that. That is bank loan. That's okay. The current liability might have more things, not just borrowings. So you can't assume that way. You can't assume. Yes. You can't assume whatever you feel like. That is not possible. So here you can't assume that is only current liability. There might be more current liability. There will be more current assets. Okay, don't assume that only. We have more information from where you can find that out. Guys, I'll give you a hint. You have current ratio. You have net working capital. From that, you will get a relation between current asset and current liability in both. Substitute one in the other. You will find it. Ashte. Heli. You want me to repeat? So basically, you have current ratio. Current assets divided by current liability 2.5. Then you have working capital. Current assets minus current liability. So first one, current assets is equal to 2.5 times current liability. You put that in the below equation. 2.5 CL minus CL is equal to whatever number. And you will get 1.5 CL equal to whatever, and CL is equal to divided by 1.5 will give you CL. Did not understand again? If you want, I can do. You try it. I'll do it anyways. I'll do. For now, this is what I'm intending to do. You had something. Tell me. You wanted to tell me something. Okay. That's okay. Inside this, inside current asset, always stock. And if you don't have any other information, you write other current asset. PE. What is PE? Prepaid expense. Okay. You can assume that. Okay. Okay. Fine. This is okay. This is okay. So you're assuming equity share cap is 0? Not possible. You can't assume that. Yeah. You can't assume equity share capital is 0. Whatever is the question. Please don't assume. Just make a logical assumption, not illogical assumption. Equity share capital has to. I told you these 4 elements has to be there. Equity. There can't be a scenario where there's no equity share capital. Okay. The rest is at least understandable. But equity share capital has to be there. Fixed asset portion has to be there. Current asset, current liability has to be there, more or less. But equity share capital, you can't assume it as 0. Okay, please don't do that. This is okay. This I agree. But what you do is under current asset, you write one stock so much, and below that you write other current asset. And you do the balance. Under current liability is also same, right? Bank OD comes within current liability. Okay, so these two together is current liability. This is not current, other current liability. Yeah, this is also part of current liability. So what to do is, if you want to do, what you can do is current liability 80,000. Under that two sections. One is bank OD, another one other current liabilities. But then we have one big component left. That is this question. Okay. Balancing figure. Okay. Find me the balancing figure. Guys, current asset and current liability, everybody okay? No? I can do it for you. That is very easy, guys. Current assets, current liability, very easy. What you have is, you have one equation where current ratio, how much have they told current ratio? Current ratio, current assets divided by current liability equal to 2.5. This means current assets is equal to 2.5 current liability. This is one equation. Second one, what they have told, current assets minus current liability, how much? Is 2. Net working capital, 1 lakh 20,000. Okay. So from here we can use current assets is equal to 2.5 CL. So here I will substitute 2.5 CL minus CL is equal to 1 lakh 20. From here 1.5 CL is equal to 1 lakh 20. From here we have current liability is equal to 1 lakh 20,000 divided by 1.5. This is how much? 80,000 is current liability. Now we can find current assets. Current assets is equal to 2.5 times current liability. So this is 2.5 into 80,000. This comes to 2 lakh rupees. This one is okay. This is current asset and current. This is easy. Now you have the rest. Rest of the question, please do it. This is the easy part of the question. Now you have some small twist. This is little bit of a Kit Kat question, actually. You had current asset, current liability. Okay. Now find the rest. Because this adjustment normally seen in every question, guys. CACL relation they will give you. Use them to find CA and CL. Okay, fine. Try ಮಾಡಿ. ಇಷ್ಟು ಆಯ್ತು guys. Which is okay. Okay, now go for the rest. Now you have some quick ratio, right? By using quick ratio, you can find out something. What you can find out? Inventory you can find out. Just like how we did before. Guys, you don't have any demo classes today, right? You don't have it? Sure. Okay. Because yesterday, Lata asked me to leave you at 1:30. I don't know why, but then you don't have any demo. What cancelled? There was a demo class. That got cancelled. Oh, that's why. Okay. Ah. Mm. Okay. Okay. 1 minute. Go back. Mm. Mm. Okay. 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 Mm. No. Ashwini, try Madi. You are trying Madi. Okay, Madi. Thinking. So, okay, think. Guys, anybody have fixed asset or anybody have any other number that you want to tell me? Do anybody have fixed asset? If anybody have fixed asset, please tell. Or equity share capital. Either of them. Either equity share or I don't know. But that number is not correct. Final number what you told is not correct. That I don't know. That I will check later. I will anyways explain it. Let me check. What have you done? No, go there. Mm. Mm. Okay. Mm. 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 Okay. Okay. I think there's something wrong with your mathematics then maybe. What is this thing? E 0.25, okay. Minus 0.25, is it? It goes 1.25, it happens. Just check your mathematics once again. I don't think this way you should get the answer, but some mathematics problem looks like. Mm. 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 Yes, yes. So this, what are you minusing from here? This is total. Okay, tell me how much it is. If you have equity share capital, you tell me. How much are you getting into the share capital? Guys, everybody have inventories? How much? How much? 80,000 inventory. 80. Everybody 80. Okay. Anybody has or equity share capital? Fixed asset? X. Even if it's X, find that X. 1 lakh? 1.5 is it? What is it? Fixed asset? No. X, finding X is the biggest problem, guys. Not just in mathematics. Guys, let's do this together now. Okay. The current asset, current liability part, everybody is clear? Okay. So you have a fixed asset here. You have a current assets here. In current asset, you have stock. How much is stock? 80,000. How much is the current assets? Total 2 lakh, right? So 2 lakh, one piece is 80,000. So I'll write other current assets. Okay, other current asset is how much? Because current asset is 2 lakh. So these two together should happen. We don't know what is the component. I'll just simply write other current assets. Then equity share capital, I don't know. Then I have reserves and surplus. Then I have what? A bank OD, which is part of current liability. Bank OD. And then how much is bank OD? Bank OD is 20,000. 20,000. And we know what is the current liability? 80,000. So we know other current liability. How much? 60,000. This much is okay. Then reserves given how much? 80,000. This much is over. Now they have given something more. Liquid ratio. You have used working capital reserves and surplus, bank OD, fixed asset to current ratio, liquid ratio, everything else. Now, only one thing we have left: fixed asset to proprietary ratio. Fixed assets to proprietary ratio or proprietors fund ratio. Proprietors fund is equal to how much? 0.75. Okay. Now guys, proprietary fund, they did not talk anything about the preference share. Either you can keep it, no problem, or you cannot keep it. I don't have any problem. For now, for my ease, I will just call this equity share capital plus reserves and surplus. Okay. Or if you want, I'll leave it like this only. Just look closely here. One minute. Total liability, total asset are same. Doesn't really matter. Okay. So guys, fixed asset means total asset minus current assets. This much is okay. So I change. Proprietors fund is this portion. So I'll say total asset minus current liability. This is okay. From here, we know current asset. We know current liability. TA, we don't know. We'll find out. Minus what is current assets? 2 lakh. Divided by total as we don't know. What is current liability? 80,000 is equal to 0.75. Just cross multiply. TA minus 2 lakh is equal to 0.75 TA minus how much? 60,000. This comes here. How much? 0.25 TA. 1 TA minus 0.75 TA. This goes there. Minus 2 lakh will become 2 lakh 60. This minus there, it goes in positive. So TA, how much is TA? 2 lakh 60,000 divided by 0.25. How much is this? 5 lakh 60,000. Now over. Now total asset we know 5 lakh 60. This is the balancing figure. 2 lakh. 2 lakh. This is minus. Okay, this is plus. But this is 1 lakh 40. TA minus 60,000. Okay. Wait, hold on. TA, this comes here, okay? TA minus 0.75 TA is equal to 2 lakh minus 60,000. This is correct? Sure? Okay. So this is how much? 0.25 TA is equal to how much? 1 lakh 40. How much is TA? Earlier we had some other numbers, still you got 5 lakh 60, yeah? Okay, fine. 0.25, how much is this? 5 lakh 60. Every time, previously I had a different number, I still got, please. She told that answer. Okay, fine. This is 5 lakh 60 end of the day. Okay. Now this is 5 lakh 60. This is also 5 lakh 60. Now it is just the balancing figures. Here you take balancing figure, how much? 3 lakh 60. Here also balancing figure. Either what you can do is, you can either call it equity share capital plus preference share capital. I don't have any problem. Or you can simply call it equity share capital. I don't have any problem. But how much is equity share capital plus resources of, equity share capital plus preference share capital? Or let's call it this way, the same term that they have used, proprietary fund. Proprietary fund, let's use it that way. Okay, how much is proprietary fund? How much is proprietary fund? 4 lakh 80. because this is also forming part of proprietary fund. So this total is, this is 80, that is within proprietary fund. So we have equity share capital plus preference share capital something. This total is 4 lakh 80,000. And out of this, these two will become 4 lakh. Ashte? Right. So this is also a balancing. Understood? So we just changed this fixed asset to total asset. Here, the same thing. You can do. There are other ways to do also, no problem. Anyways, okay. This is pure mathematics. There are other ways to do. If you want to do this way, you can do. If you have some other means, you can do that. No problem. What you should have got, what happened? Just check. You should get the same thing. Shouldn't be a problem. Because all things should get. Maybe some error going here and there. You got now? No? Turnover ratios. Turnover ratios. On. Turnover ratios. Turnover ratios. Turnover ratios. Guys, turnover ratios basically gives you how efficiently is company using its assets is what this one will give you. Guys, turnover ratio or activity ratio or performance ratio, these ratios will tell you how effectively are you using each element of a company, how effectively are you using. This is what these ratios will tell you. Okay, it will give you the efficiency at which the company uses its assets. Okay, different assets. Okay, that is what these ratios will tell you. Right below these ratios, these ratios these ratios these ratios help us identify, help us evaluate. These ratios help us evaluate the efficiency with which the firm manages, the efficiency with which the efficiency with which the firm manages, the efficiency with which the firm manages and utilizes its assets, and utilizes its assets. Okay, efficiency with which the firm manages and utilizes its asset. So these ratios we will discuss here will basically tell you how good, how well are you using your assets, or how well or how not well you are using the asset. First one, guys, total asset turnover ratio. Total asset turnover ratio. These ratios are easy to remember. Any turnover ratio, what will happen is sales divided by that sum. So here, guys, total asset turnover ratio will be either sales or COGS. Okay, these two, please remember, all the turnover ratio will have in numerator either sales or COGS, divided by whatever name you have. Here you have total assets, total assets. Okay. So all the turnover ratio will have sales or COGS in the numerator. Denominator, you will have whatever they tell you. It's very easy to remember. Total sales, total asset turnover ratio is basically sales or COGS divided by total asset. So guys, this particular ratio tells us how well are you using your, or say you're making a sale of 10 crore by using an asset of 1 crore, which means you are using the assets to generate 10 times the sales. You are using your total asset and you are generating 10 times the sales. You are utilizing the asset. So what happens is, say you have two companies. You want to evaluate how well they are using your asset. You can compare those two, which is in the same industry. Okay, different industry, it doesn't make sense to compare. You have to compare two companies in the same industry in the same environment. So then you will see how well the assets are being used. So this is the total assets turnover ratio. Total asset turnover ratio is equal to sales or COGS divided by total asset. Now here, guys, COGS. Okay, COGS. Now when you have to use COGS, when you have sales. In the question, if you have any information to find out the COGS, if directly given or indirectly you have some information to find out COGS, always use COGS index. If you have directly given COGS, or if you have some information from which you can compute COGS, always use COGS. If there is no COGS in the question, if there is no way to find out COGS, then you use sales. This is your more of a thumb rule. Okay, if you have COGS or if you have any information to find out COGS, use COGS in the entire equation. If you don't have any information to find out COGS, and if you don't have any COGS, then you use sales. Let's write that first, because this becomes a problem when you actually do the problem. So let's write that. You put a star in COGS. Okay, put a star in COGS. So put a star in COGS. In the exam question, COGS has to be used in the equation. COGS has to be used in the equation. COGS has to be used in the equation. COGS has to be used in the turnover. You can simply say in all turnover, not just for this. In all turnover ratio, you have to follow this principle, okay? So in the exam question, COGS, what did we write in the exam question? COGS has to be used in the equation if if COGS is available, if COGS is available, if COGS is available, or COGS can be found out, COGS can be found out, COGS can be found out indirectly, right in the next line. If there is no information, if there is no information, if there is no information available, if there is no information, if there is no information available, to find out COGS, to find out COGS, to find out COGS, comma, only then, only then, only then use sales, only then use sales in the turnover ratios, only then use sales in the turnover ratios. Okay. Sometimes guys question will say total asset turnover ratio, in bracket they will say based on sales. If they tell specifically, use that, otherwise follow this principle. In the question you use it, in question if they say based on COGS, you use COGS, and in question very silent and then they give directly COGS, use COGS, and indirectly they give COGS, or indirectly you can find out COGS, then use COGS. Okay, if no information available, directly COGS, or no information to find out COGS, then you go for sales. So sales get a second preference. The first preference is always COGS. Okay. Then next one, fixed asset turnover ratio. Fixed asset turnover ratio. Fixed asset turnover ratio. What will be? Sales or COGS divided by fixed asset. Fixed asset turnover ratio is sales or COGS divided by fixed asset. Next one, net asset turnover. Net asset turnover ratio. Net asset turnover ratio. Net asset turnover ratio. What it will be? Sales or COGS divided by net asset. You know what net asset is? What is net assets? Or it is also called capital employed. Okay, so guys, net asset turnover ratio is equal to sales or COGS divided by net assets. This ratio is also called as capital turnover ratio. Write in bracket, net asset turnover you wrote, right? In bracket you write capital turnover ratio. So capital turnover ratio and net asset turnover ratio is exactly same. Capital turnover ratio is basically capital employed term. They are bringing it here. Okay, so net asset turnover ratio or capital turnover ratio, both are same. Sales or COGS divided by net assets. Okay, net asset, you know what? It is either capital employed or okay. Then let's move to the next one. Current asset turnover ratio. Current asset turnover ratio. How will you find out? Sales or COGS divided by current assets. Okay. So current asset turnover ratio is what? Sales or COGS divided by current assets. Next one, working capital turnover ratio. Working capital turnover ratio. Working capital turnover ratio. How will you write? Sales or COGS divided by net working capital or simply working capital. Both means the same thing. Okay, now working capital is over. Now we have under working capital, we have more ratios, guys. Under working capital turnover ratio, we have inventory turnover ratio, we have receivable turnover ratio, we have payable turnover ratio. This is within working capital, because working capital has current assets, debtors, inventory, and current liability has payable. So all these three again split. Okay. So under net working capital ratio, we have three ratios. First one is inventory or stock turnover ratio. Inventory or stock turnover ratio. Inventory or stock turnover ratio. How will you find out? Sales or COGS divided by average inventory. You write average inventory. Okay. Sales or COGS divided by average inventory. Sorry. Yeah, average of 1 year. So average inventory turnover ratio is equal to cost of goods sales or cost of goods sold divided by average inventory. So average inventory, how can you find out? Opening plus closing divided by 2. Okay, please write that also. Average inventory is equal to opening inventory plus closing inventory divided by 2. Okay, average inventory is equal to opening stock plus closing stock divided by 2. Sales or COGS divided by average inventory. Average inventory is opening stock plus closing stock divided by 2. Then under that, you have more. Okay. This one, do we have to use it here? 1 minute. Okay. Okay, so guys, we have more. So inventory turnover ratio is over COGS or sales divided by average inventory. Under that, under inventory, you have more. You have raw material inventory turnover ratio. Raw material inventory turnover ratio. This is within inventory. Okay, within inventory turnover ratio, we have raw material inventory ratio. Here it is not like normal. Okay, here it is not like sales or COGS divided by. Here it is raw material consumed divided by average raw material stock. Raw material inventory turnover ratio is equal to raw material consumed divided by average raw material stock. Raw material inventory turnover ratio is equal to raw material consumed divided by average raw material stock. So guys, when it comes to raw material, you can't sell the raw material. There is no cost of goods sold. So what it is, raw material is consumed. So that's why the numerator changed. Okay, you can't sell raw material directly. Raw material has to be processed. So raw material, what happens? The finished The finishing of raw material is raw material consumption. So that's why in the numerator we have raw material consumption divided by average raw material stock. Divided by average raw material stock. Okay. W plus F. Just 1 minute, guys. There's one more thing we need to write. Raw material inventory is over. Now we need to write about raw materials over. We have WIP, you know WIP, 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 work in progress, you know finished goods, all this you know already. Okay, let's write that also together. 1 minute. Okay, guys, let's leave it there. We'll not go for WAP for now. We'll talk later. Okay, we'll talk in anyways. This entire portion we have to talk again in working capital. So for now, just this much is enough. We'll talk about the WIP and the finished goods in the working cap chapter. Anyways, we need to talk all this again, okay, because this is part of working cap. Move on to the next one, guys. Debtors turnover ratio. Debtors turnover ratio. Debtors turnover ratio. Debtors turnover ratio. So debtors turnover ratio, you can find out using credit sales divided by average debtors. Debtors turnover ratio is equal to credit sales divided by average debtors. So this will give you how fast the sales is converting to cash. Okay. Credit sales divided by average debtors. Okay. Then below, next one. These things. Can't skip it. Okay, guys, write one more. Receivable turnover ratio already wrote, right? Okay. Then next one. So debtors turnover ratio is basically giving how fast the sales to cash. So basically credit sales divided by average accounts receivable. If average accounts is smaller, means the credit sale is converting faster to cash. Okay, so that's what it means. So this gives the rate speed at which the credit sales that is converted to cash. Okay, you can assess that from here. Okay, now debtors velocity or average collection period. Debtors average collection period. Average collection period. Debtors average collection period. Debtors average collection period, or we call it debtors velocity. Guys, average debtors collection period, or we call this one debtors velocity. Debtors velocity. Either we can compute using average accounts receivable, average debtors divided by average daily credit sales. So basically this will give you guys, so if you're making a sale of say 1 lakh every day and you are having an average debtor of 30 lakhs, so 30 days this is basically getting collected. In 30 days the money will come back as cash. Okay, this is debtors collection period, or debtors velocity. Or you can even find out by another formula, okay, by using another formula, 12 months or 360 days. How this will come, I'll tell you. 12 months or 360 days or 52 weeks. Let's do 52 weeks first, then 360 days. 52 weeks, 360 days divided by debtors turnover ratio. Can you tell me what is debtors turnover ratio? Credit sales divided by average debtors divided by 12 months. Let's just take 360 days for simplicity. Okay, now if this goes up, guys, average debtors divided by credit sales, average debtors divided by credit sales, debtors turnover ratio, debtor turnover credit sales, this credit sales divided by average debtors, right? Average debtors divided by credit sales. Credit sales into 360. This became every day, right? 1 minute. This is becoming same. Debtors turnover ratio divided by 1 minute. This is the formula. 1 minute. 12 months debtors turnover ratio divided by average accounts receivable. This is average debtors, credit sales. Okay, just write this formula, guys. I'll come back. Okay, just write this formula for now. Average debtors collection period is equal to average debtors divided by average daily credit sales, or 12 months or 52 weeks 360 divided by debtors turnover ratio. We'll come back to this. Okay, we'll come back to this. 360 days or 12 months or 52 weeks, depending upon the scenario. If they give the days, use 360. If they give months, you use 12 months. If you give weeks, take 52 weeks. Okay, 360 or 365, it's okay, no problem. Should be. Come back to this. 365, if you want, you take 365, because in the question they will give you 365. It's easier to do proper 360, so we'll take 360. If you want 365, no problem, just take an assumption. In the exam, if they've given, just use that. Okay, then we'll move on to the payable turnover ratio. Payable turnover ratio. Payable turnover ratio. What will be payable turnover ratio? In debtors, we sold. So we took average sales, credit sales. We took credit sales divided by what average debtors. Here what will happen? Payables, what will do? Purchases. Credit purchases divided by average creditors. Then same creditors velocity, payable velocity or creditors payment period. Creditors payment period or payable velocity or creditors velocity. Creditors payment period or creditors velocity, payable velocity is equal to average payable, average accounts payable, or average creditors, sorry, average creditors or average accounts payable, same thing, average creditors divided by average daily credit purchase, divided by average daily credit purchase. Average accounts, average creditors divided by average daily credit purchase. Or you can do the similar equation, 12 months to 52 weeks or 360 days divided by payable turnover ratio. Okay. Now we have some more formulas, guys. Let's finish it in a stretch, then we'll do the problems together. We'll move on to the profitability ratios. Let's see how much you can finish. This is all easy ratios which you have already studied, so there's nothing much here. Guys, profitability ratios. So this will measure the profitability, okay, or the operational efficiency. It will measure the operational efficiency or the profitability. Profitability ratio means profitability ratios. You put a heading profitability ratios right below. The profitability ratio measures the profitability. The profitability ratios measure the profitability. The profitability ratios measure the profitability. The profitability ratios measure the profitability or the operational efficiency of the firm. Or operational efficiency of the firm. Measure the profitability or the operational efficiency of the firm. Okay, let's go one by one. Okay, first one. First category, guys, based on sales. Put a small heading, based on sales. Profitability ratio based on sales. Profitability ratio based on sales. Profitability ratio based on sales. First one, GP ratio, gross profit ratio. GP ratio or gross profit ratio. Gross profit ratio or GP ratio. What is GP ratio? Gross profit. How will you find out? What is the formula? Gross profit divided by sales into 100. Gross profit divided by sales into 100. You've been doing this since long time. You know this thing, right? Where you say profit on GP, profit on profit on COGS and profit on sales. This you know, right? I'm assuming you know that. 25% cost on profit, profit on cost is equal to 20% cost profit on sales. You know this thing. You did by heart. You know by heart, guys. This one. 25% profit on cost is equal to 20% profit on sale. You know this thing, how to, if you, this is given, you know how to compute this. Okay, 10% profit on cost, how much is on sale? Tell me how much percentage profit on sales. I'm telling you 10% profit on cost. Tell me what is the percentage on profit on sales. 9.09. Simma, how? Don't know. I forgot. Guys. Okay, GP. This you should know because this you've been learning in so many since +1, +2. I think you should be learning, or till 11th, 12th you have learning in foundation also. I've been BCom also, you would have learned a lot. Guys, this scenario, how it happens. What you just have to draw three things. Okay, first one, cost, GP, sales. Okay, there is only three scenarios. First scenario, I told you 25% on cost. So GP is 25. When on cost, which means if cost is 100, profit is 25. Cost is 100, sales is 25. So then sales has to be 125. Then we want the percentage GP on sales. So you can do 25 divided by 125. How much is this? 20%. This is how you got this one. Similarly, same 10% profit on cost, which means profit is 10. Profit is 10. And profit is 10. And then cost is 100. How much is sales then? 110. How much is the percentage? 9.09. Now let me give you one more scenario. Percentage profit. Okay, it is 90 percentage profit on sale. What percentage profit on cost? Tell me. 90% profit on sale. How much percentage profit on cost? Guys, you see all this. You guys are looking as if you're seeing it for the first time. ಎಷ್ಟು? How much? ಎಷ್ಟು? How much? More value. Oh, so you're confused now. I don't know. You tell me. You got more value. 900%. Oh, then there is. I don't know. Huh? Then you will see. It may be 900. I'm not saying it is wrong. Okay, I have to do only then. No answer. It's okay. Someone else find out. Huh? Someone else finding out. ಎಷ್ಟು? 900. Everybody got 900. Okay, then let's test it. It will be correct. I don't know. 90% profit on sale, which means profit is 90. If sales is 100, profit and how much is the cost? 10. We want a percentage profit on cost. How much is cost? 10. How much is sales? 100. Correct? Okay. 10 is the cost. Okay, sorry. 90 is the GP. Cost is 10, which is how much? 900 percentage. 9 or into 100%, 900%. I will give you one more. Last one. Simma, you have to tell me, Simma, okay? 15% profit on sale, Simma. How much percentage profit on cost? Simma, ಸ್ವಲ್ಪ ಹೇಳಿ Simma. ಎಷ್ಟು Simma? 56. Okay, let's trust you saying 56. 15% profit on sale. So profit is 15. Sale, right? So sales, if sales is 100, this is 50. How much is this? 85. So how will you find this out? 15 divided by 85. How much is this coming to? 17 point. I'll give you one more attempt, Sima. 10 percentage. No, not 10%. Okay. 40 percentage profit on cost. Okay. How much percentage profit on sales? 40% profit on cost. How much percentage profit on Sima? Heli. Sima ಎಷ್ಟು? ಮಾಡ್ತಾ 28.5 you say. Okay, let's see. GP is 40 on cost, right? Which means cost is 100. So this is 140. So 40 divided by 140, how much is this? How much did you say? Same. Okay, 28 point something. Okay, understood. This is what we have been doing. Time's up. Let's just write one more formula, guys. Net profit ratio. We'll stop there. Net profit ratio. Net profit ratio. We'll write two more, okay? Because we'll finish that section. Net profit ratio is equal to what? Net profit divided by sales. Net profit divided by sales into 100. Net profit divided by sales into 100. So guys, what is this net profit? It can be EAT, it can be EBT also. Depending upon the scenario, you can use it. If they say net profit after tax, it means EAT. Net profit before tax means EBT. Now, simply net profit, I normally suggest you to take EAT after tax. Okay, normally, because when you say net profit, it is after. Forget about FM. Let's come to accounts. Net profit means after everything, which means EAT. Okay. Okay. Then next one, operating profit ratio. Operating profit ratio. Operating profit ratio. Operating profit ratio is equal to operating profit divided by sales into 100. Operating profit ratio is equal to operating profit divided by sales into 100. What is operating profit? Operating profit, net operating profit in FM. EBIT. We have been talking about this in so many chapters. So you can write that also in operating profit. You write in bracket EBIT divided by sales into 100. Operating profit is equal to EBIT divided by sales into 100. Then last one more ratio and then we'll stop up. Expenses ratio. Expenses ratio. Expenses ratio. What this means is, guys, they might give you a cost of goods ratio, for example, which means whatever that expense divided by sales into 100. If they've given COGS ratio, COGS divided by sales into 100. If they see operating expense ratio, operating expense divided by sales into 100. If they say operating financial expense divided by sales into whatever expense they give divided by sales into 100. I think that much should be enough. Expense ratio, like then you write expense ratio is equal to expense divided by sales into 100. Expense ratio is equal to expense divided by sales into 100. Like whatever expense they give you, okay, this is not expense they'll give you. They'll give you either cost of goods sold ratio or operating expense ratio or financial expense ratio or operating ratio. So they'll keep giving some ratio. You'd have to take their expense divided by sales into 100. We'll stop here, guys. We'll just let me tell you what are the things that you can try. You can try question number 1. Question number 1 is very much doable now. There's nothing to, no problems there. Question number 1. Then 2 and 3 over, right? Fourth one, you leave it to me. We'll do it together. Fifth one also you leave it to me. We'll do it together. Okay. Sixth one, you leave it for now. Seventh one, did we do? No, seventh one you can do it. You can do question number 7. Question number 8, we can do it together. Question number 9 you can do. 1 minute. Question number 9. Question number 9, we'll leave it for now. Question number 10 we did, right? Question number 11 you can't do. Question number 12, then probably try question number 12. Try 12. Then 13, it has a current ratio in enough liquidity. You are required to comment whether current ratio will improve, decline, or remain unchanged. 13 anyways we'll discuss. Okay, so which are the ones that you have to do? 1, 1, 7, 12. Only 3 is it? You can try maybe one more. I'm just thinking which one. You can probably try which one? I'm just thinking. You want to try 6? You want to try? Try 6, guys. Try 6 also. Try 6. Try 6. Finished goods inventory holding period. Okay, then you leave 6. Don't do 6. Ashtasaku. Okay, guys, we'll break today. Tomorrow is a holiday. Okay, we'll break tomorrow. Tomorrow is a holiday. We'll cut the cake today, okay? Tomorrow is a holiday and day after also holiday. We'll start on Monday. We need only 3 more days mostly, so we'll finish by Wednesday or maximum Thursday. Okay, we'll wrap up today, and tomorrow there is no class. Tomorrow and day after. We'll cut a cake. Not buy any cake, right? Today, tomorrow. That's why. That's why I'm confirming. I know you did not, but still, I will cut a cake. Happy birthday to me. Okay. Or Good Friday. Tomorrow is a holiday. Good Friday. You want me to cut or you want to you cut? Any professional cake cutters? Any I bought a knife also for you guys. Birthday song in Malayalam. My birthday is on June, guys, so we can't do anything about it now. How do you cut this? Advance. Okay, advance and advance. Then how? What do we do with Good Friday? Today is Good Friday, guys. Please. It's very happy Friday. I also want a break. I also want the Friday to be good, so I took a break. It's a plum cake. This is eggless. Okay, don't worry. This is eggless only. We cut from here. How do you? Huh? Who is eggless here? So many people still eggless. Guys, you should try egg someday. Okay. Do we have a plate somewhere where we can keep it? No. Anybody have a plate? No. Will we have a plate here? Sima has a plate. No. He'll go home and take a plate and come back. Please. Okay, we have a small cake, guys. We don't have a big cake. We'll cut the cake. Anybody professional cutters? No professional. My hand full dirty, guys. I'll just wash my hand and come. Okay. Plate here. Plate. You can stop.